Welcome to the first Barchart webinar of the new year. Hello, everyone, and Happy New Year. Barchart has planned an exciting schedule of a wide range of timely subject matters in the coming year. Many of these subjects were suggested by you, our subscriber and viewers. So our goal this year is to educate you on a variety of trading and investment concepts, to inform you about the pages and tools Barchart provides related to these ideas, and finally, to offer you some food for thought to help you make a more informed investment decision. So today's subject is a food for thought session, and it's a little bit outside the box from our typical sessions. We're not going to look at a lot of charts or data pages. Instead, we're going to talk about the philosophy of trading, the 5 common traits of successful traders. Now, when we look at the different types of traders, there's many styles as there are traders or investors, and each has unique goals, time frames, rules, and different traded markets. But those who tend to be successful or pass the test of time have common traits that adhere to their success. So, welcome everybody. My name is John Rowland. I'm Barchart's head of trading education. And in my professional career that is now spanning 40 years, I've had the pleasure and the opportunity of meeting, working, and getting to know some of these modern day most successful traders. During that time, these traders shared ideas, thoughts, and strategies about trading that went on to shape and influence my style. But I also recognized that there are commonalities that they all possessed. So before I share those with you, please welcome my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene, and Happy New Year.
Happy New Year, John. Happy New Year to everybody else who's joining us today as well.
Are you excited about this coming year? I know we've been working hard to make our webinar a little fresher, right?
We are going to present some great topics this year. I just know it. I just feel it, right?
I think so. Yeah, we kind of got to figure it out, but I think this is going to be a really good year for all of us. So yes. I'm excited, and I hope you are, and our viewers are as well. Okay, so just to get started, always, today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or other investments involves risks and best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damages you or anyone else incurs as a result of trading or investment activity that you or anyone else engages in based on information or material that you receive through barchart.com or our services. Okay. So what are the 5 traits of successful traders? Objectivity, discipline, risk management, adaptive skills, we'll talk about survivorship, and observationists. These 5 skills, these 5 traits are common through all of these successful traders. Objectivity, right? All of these traders will look at markets and are able to look at them with an analytical lens. In other words, very mechanical or mathematical in a historical perspective or strategically, and not with emotions or subjectivity. In other words, they're able to separate facts from fiction or emotion, and are not opinionated, because opinions will cloud their judgment. We don't want to tell the market what to do. We want to listen to what the market is telling us. But also, can I build a trade plan, an objective trade plan around trusted, reliable, and historical data? In Ned Davis's book, Being Right or Making Money, he describes the objective indicator as it must be mathematical and long historical analysis to demonstrate effectiveness. So when we choose our inputs, can those inputs be quantified or tested? And what is really important is as we build our plan out, as we build this objective plan, we want to make sure that the things that we're using are not correlated. In other words, they want to be looking at the markets from different perspectives. So for instance, here is Archer Daniels Midland. And whatever formulas that I'm going to look at or how I'm going to break down this market, can I rely on the data that I'm looking at? Can I rely on the information that I want to use? For instance, maybe I might use moving averages. So here I'm adding a template that has 20, 50, 100, and 200-day moving averages. Can I test when price gets above, when those moving averages cross? Is it giving me a buy signal? Is it giving me a sell signal? Can I go back in history and check this reliability of this indicator or the historical performance of that indicator? But then if I look at other things, I want to make sure that whatever I look at besides moving averages are non-correlated. For instance, maybe moving averages in terms of volume. I want to see if volume is correlating with my my chart. Now here I have it on top of my chart. Let me see if I can make this a little clearer for a second. Let's get rid of that and put it back on. Instead of the same pane, let's make it a different pane. Let's see. Whoop. Let's choose a different pane. There we go. All right, this will look nicer. All right, I want to see if volume correlates, helps me look at the market in a different perspective. Maybe I'll look at volatility. I want to look at a volatility study, for instance, Bollinger Bands. A measurement of volatility. Now, Bollinger Bands does have a moving average inside of it, but we're really looking at standard deviations. Again, I want to make sure that my trade plan or the way I'm going to look at the market, all these different objective indicators are going to give me some defined signals. Can I test those signals? And do I have historical data to use these signals as a reliable information? So when I was in the late 80s to mid 90s, I was working for a firm that was called ED&F Man, which was part of the Man Group. And one of the other parts of the Man Group was a fund called the Mint Fund. It was a very successful commodity fund. And the head trader at that time was a fellow named Larry Height. Now, I knew of Larry, and Larry knew of me because we worked on the same floor, same vicinity, and we'd bump into each other on occasion, right? But we were more a business acquaintance than we were friends. But one morning, I was getting onto the elevator, and this hadn't been the day after Mint had announced their results for the previous year, and they were up over 60% for the year. And, just a little morning elevator chit-chat, I said something like, oh, it must be fun to make that kind of money, right? And his response was kind of odd. He said to me, no, trading shouldn't be fun. It implies emotion. And I thought that this was odd, but very insightful. What it was telling me was that trading is a business, right? And that we can't let emotions dictate our business decision. This was a very powerful lesson I learned as a young trader. But later, what I'm going to do is when we talk about risk control, we'll come back and talk about Larry's strategy. And I think this statement will make a lot more sense to you because it is kind of cold and dark if you think about it. Discipline is a common trait among these traders. We need to build a skill set to allow us to repeat success and to grow from our mistakes, to learn from our mistakes. So, regardless of the profession, if you think about this, doctor, athlete, artist, trader, in order for us to achieve these high levels of success, we all need disciplines. And so discipline takes many shapes and forms. So one type of discipline we could have is a routine. How I start my day. I look at it, overnight markets. I look at the headline news. I look at what economic reports are going to come out. Which ones are going to affect my markets? I'm going to look at the futures markets, see what is the pre-opening, what is the pre-market indications for some of the stocks. Am I anticipating them going to gap up or gap down? Could I start implementing my trade plan based on that information? But also, I want to have a routine that how I dissect a trade, how I pick my entry, how I set my stop, how I look for targets. Is the risk reward worth it? Is the relationship to trend the trade that I want to take? And I want these routines to be repeatable so I can create this muscle memory. Now, what muscle memory are we really talking about here? We're talking about our trader's brain, right? Something that is repeatable. Now, I had a high school coach that used to say something like this. He used to say, "Oh, perfect practice makes perfect, right? Practice doesn't make perfect. Perfect practice makes perfect." And, you know, that's kind of what we have to think about. We have to practice every day like it's the real thing. And the other thing he used to always say is practice like it's game day, and then on game day, play like you practice. And again, this is this muscle memory that we want to kind of try to achieve in our routine. But also, inside of our trade plan, we want to have some structure, some rules, some disciplines, our do's and our don'ts. You know, our what ifs and when to. Right? These rules are designed to help us so we can rely upon them so we don't have to think about it, right? Especially when the markets are volatile or active or we're under pressure or under stress, right? So the rules are there for a reason, to protect us, to help us. And finally, a discipline of accountability. Many of these traders that I've talked to over the years, they all talk about this accountability issue, that when they break their rules, what things are they going to do to put themselves back in line? Now, many of them, including myself, one of my accountability rules is if I break one of my rules where I create a loss or even a winner, I will give myself a day off. I'll say, hey, you need to take a day off. You're not respecting your rules. And it makes me think about and refocusing on my rules and my disciplines, right? But other traders will tell me, you know, if they break a rule, one of the accountability rules they would do is they will cut back on their position size or cut back on their risk, right? That keeps them in line because I know that when they start to become undisciplined, that's when they start making mistakes. And when they make mistakes, it could be very costly. So these rules and structures and routines allow us to react and not overthink. We wait for the situation, we wait for the opportunity to present itself, and we execute our plan. We don't have to think about it. Our routine, our muscle memory will allow us to execute that plan without any thinking. And that's where we want to make trading very mechanical, right? These disciplines allow us to react and not think about emotions, right? Think about this. who's ever sat in front of the screen and watched one of their stocks or one of the positions go up and go, woohoo, it's going up, it's going to the moon, right? That's emotion, right? We don't want to think like that, right? Yeah, it's nice that we have a winning trade, but what we should be thinking about at that moment is, okay, market's rewarding me. Now, do I want to set a new target? Do I want to adjust my stops? Maybe I'll give myself permission to add on to my position, or I'm giving myself permission to take profits. Rules and disciplines, not emotions. Risk management, crucial to all traders. Every trader has a different rules of risk, and these rules are going to be based on their risk tolerance, right? But every successful trader has rules. Now, Benjamin Franklin said that those who fail to plan are sure planning on failure. And I love that quote. So what I want to do is I kind of want to share with you some risk management skills that I've picked up from some of these traders, these great traders. So I first met Mark Fisher in 1980 on the COMEX exchange. And Mark was just starting his career. He was a very successful trader. And in a very short period of time, Mark was able to start his own clearinghouse, MBF. And that clearinghouse went on to become one of the largest independent trader clearinghouses, what we would call a locals clearinghouse. Now, what Mark would do was he would take in young people and teach them how to trade, and he would sponsor them and put them in the ring. Now, inevitably, what would happen would that one of these traders would have a series of bad days or have some big losses or start to break some of Mark's particular trading rules. And so Mark would send down his henchman, a fellow named Joe Terranova. And for those of you that might recognize that name, yes, that's the same Joe Terranova you see on CNBC in like the power lunch segments on the television. But Joe would go down to the floor and he'd tap you on the shoulder. And that meant that you needed to go up and see Mark right at that moment. Now, I wasn't one of Mark's minions, but I was an independent trader, and Mark and I respected each other. Matter of fact, I helped Mark on occasions training some of these junior traders. And, you know, I'll be honest with you, I got tapped on the shoulder a couple times by Joe as well. And it's like being sent to the principal's office, right? That walk from the pit to the elevator to Mark's office, you know, you're sitting there and you're thinking about, how can I defend my position? How can I tell him what I'm thinking or what I believe in or why I took this trade or why I'm allowing this loss to occur? But when you walked into Mark's office, Mark was a man of very few words. He would just look up to you and say this simple phrase: what's your risk? And Mark at that moment would polarize you, and you knew that you were over leveraged, or you had too much margin, or that you had put yourself in a risky position. What Mark was saying to you is, can you afford this risk? And Mark knew you couldn't afford this risk. He let you make your own decision, but it was Mark's way of saying you've gotten out of control and you have taken on too much risk. And if the market went against you, you'd have a catastrophic loss. So risk control, we don't want to bet it all. Mark was teaching you how to stay inside of boundaries, stay inside of risk. Paul Tudor Jones was a customer of mine when I was on the New York Mercantile Exchange in the energy pits. And he was a typical Southern gentleman. He always had time to talk about markets. He loved to spout about his philosophies of trading. He had a lot of sports analogies. I loved them. One of the ones that he would talk about when on winning positions was he equated it to like a football coach whose team is up 3 touchdowns at halftime, and how he would tell his team, hey, let's go out there in the second half and treat this game like it's a 0-0 game. right? Motivate his team, not to let them let down. But what Jones was believing at that moment when he was telling me this is that you look at every trade every day, and from the perspective of zero. In other words, not how much I'm up or how much cushion I have in the market, but what's my risk today? Would I put this trade on today? Would I take this trade off? Right? What is it based on? And what would happen in the past is not going to make the decision for me today. And what this taught me was that it was okay to take profits or to exit a trade if conditions had changed, right? Jones was basically telling me or teaching me how to respect risk every day and not just when we enter the market or exit the market. Richard Dennis was different from all the other traders I've ever met. He was aggressive. He pushed limits. He leveraged his winners, but he was also very nimble and he was quick to exit trades. Now, I remember one particular volatile day in the natural gas drink, and Dennis loved to buy new highs, and which he did on this day. And the market went up, and then he bought the market again and it went higher, and then he added to his position a third time. But by the time I had gotten back his fill to him on the third position, he immediately started selling. And his selling triggered a wave of new selling, more selling. And by the time Dennis was out of his position, natural gas was limit down. Now, he ended up being right. The next 3 days, natural gas fell very hard and had a couple more limit down days. But what I did was I waited a few days, waited for the market to cool down. And I asked him why or what happened or what was his thinking. And his response was that ours is the only profession. Now, he had a super dry sense of humor, maybe except for a weatherman, where we can be wrong more times and then right and still be successful. So Dennis went on to tell me that out of 10 trades that he takes, about 5 or 6 he knows he's going to lose. About 3, he's going to make a little bit of money or break even. And only 1 out of 10 trades is going to be a winner, a big winner. 3 to 1, 5 to 1, 20 to 1. Now, if you have the opportunity to have a logbook and you look at your trades over a longer period of time, what you will discover is that 85% of all your trades will only add up to about 10% of your profits. And 10% of your trades will account for 85% of your profits. So what Dennis was teaching me here is not about winning or losing. It's about when you have a winning trade that we want to look for trades that have greater risk-reward ratios or have a greater potential for success or greater returns. So if I'm a 50-50 trader, in other words, I have half winners, half losers, I want to look for trades where I can get at least 3 to 1. That guarantees that I will be a successful trader. And it's a lot easier to make 2 to 1 when you set up trade at 5 to 1. And it's a lot more difficult to make 5 to 1 on a trade that only has a potential of 2 to 1. So Dennis was teaching me how to look for higher quality trades and greater risk rewards. Now, as I became a more seasoned trader, and I started tutoring or mentoring younger traders. And when I was in the classroom and I was teaching, I came up with this saying. And this saying says, as soon as you start learning how to stop losing money, now trading is learning how to lose money. You do lose money in trading, but really what I'm talking about is losing big, taking those big losses. It becomes a lot easier to start making money. And that's true. If we can learn to take small losses and learn how to make big wins, we're going to become a more successful trader. So when we think about risk control, what are some of the things that I've learned from these traders? Remember Larry Hite, our mint trader? Well, his philosophy, his trade strategy was 1%. That was it. No matter how much the trade looked, how great it looked, he only risked 1% of his equity. Now, a lot of traders I've worked with over the years, and the percent rule you hear a lot is 2%, 2% of equity. And that's a rule that I stick to, 2%. Position size. Many young traders, or those who are starting out, tend to take too much position size, tend to overextend themselves. Think about Joe coming down and tapping you on the shoulder and going to see Mark. But for instance, like in Richard Dennis, he had some rules that allowed him to increase capital commitments, leverage a position, take a larger position as the market was rewarding him. But none of these traders wouldn't take more than 5% of their capital. Look at some ETFs. Go and do some investigation. And I'm not talking about the indexed ETFs, but some of these other ETFs. Notice how your portfolio managers in their top 10 holdings rarely will let one stock get above 5%. Most of them will keep that right around that 2-3% of their holdings. So they might take a 5% capital exposure, but they still will use that 2% risk rule, risk control. And finally, this thought about risk-reward ratios, right? Look for trades that have greater risk-reward ratios. You don't have to take every trade. Make sure the risk, the trade is worth the risk that you're going to take. So for instance, let's say we had a stock that was range bound between $45 and $50. And that stock looked like it was about to break out above $50, and it looked like it could move about 10%, maybe up to $55. I would take that trade, but I would only risk $1.50 to the downside. In other words, $48.50 on the belief that the market is going to go to $55, a 3-to-1 ratio. Now, maybe I could use rules of my trade plan, maybe structure from candlestick patterns or something to that effect. Maybe I could get in where my risk is only 50 cents, or I'm going to stop myself out if price removes back below 49.50. Now I'm risking 50 cents to make $5, 10-to-1. Those are the types of trades that we want to look for. What I'm not going to do is take a $50 breakout for a $5 potential profit and risk $5 on the downside. Learning how to take small losses and get greater profitability. Adaptive and survival skills. So this one is, if we think about nature, this is our fight or flight instinct, right? We have to learn this instinct, or be aware of this instinct as traders. So all these great traders have this ability to recognize change, or the wherewithal to admit that they're wrong. Now, not admit that they're wrong in sense of their ideas or their trade plan, but that the market has changed, right? And this desire that I'd rather take a loss or get out of a trade and live to fight another day instead of being stubborn, right, and taking these big losses. And this is a problem a lot of young traders have, is they hold on to trades too long. They take these big losses. right? You need that survival skill, right? In other words, let's get out, let's refresh, let's rethink, and move on, because markets change. Now, your system or your plan might have worked, but now it's not working. So maybe it's not your plan. Maybe your plan's fine. It's been successful in the past. Maybe the market has changed. Maybe you need to change markets. You need to adapt. You need to grow. You need to evaluate. Jones, adapt, evolve, compete. If you don't do those things, you're sure to die. Jesse Livermore, there's a book out there, it's called The Remnants of a Stock Operator. In that book, he talks about, exiting trades when there's a clear that the trend that you're following or profiting from is over. Now, this is very cliche-ish, right? This is very simple, but it's very direct, and I love it. When the trend changes, get out. Don't be stubborn. Don't say, hey, I'm going to hold on. It's going to come back. No. Take your loss, take your profits, run, reevaluate, reassess, reallocate your capital. William O'Neill, you'll hear this a lot from a lot of these old gun traders, that this gentleman influenced them a lot, and he has a couple books out. And one of the things that he says in one of his books is that never argue with the market, that your health and peace of mind are always more important than any stock. And I love this saying because it really gets you in that mindset of survivorship. All right. In other words, if the market is banging you on the head, in other words, you're continuing to take small losses, a lot of them. Now, you want to be disciplined and stay with your plan, but maybe the market is telling you something has changed. Again, maybe you might need to trade a different market. For me, I've never been great at trading the S&P, but my strategy and my plan seems to work a lot better in other futures markets, corn, wheat, sugar, oils. It just seems like it doesn't work in the S&P, and that's fine. I've learned to live with that. Understanding that holding on to a trade that gives you stress, that gives you grief, it makes you worry that you can't sleep at night. That's not a good position, right? Your health and your well-being and your mental state is much more important than any stock that you can own. Observationists. All successful traders have this skill. Yes, I actually looked this up. This is an actual English word. But what does this mean? All of these traders have the skill to look at the world, markets around them, and to make these connections, connecting the dots to help them find new trends and trading opportunities. What I call correlations and causations, right? Making those connections. So for us as traders, let's start small. Let's keep it simple. Let's look at and watch the patterns of human behavior that are around us. What are your consumption habits? What trends are you reacting to? So I've talked about this before in some of our sessions about an old trader that I knew. His name was Herbie Weinberger, and he was a pork belly trader, which eventually became the lean hogs contract. And what Herbie would do is he would go to the butcher shop or to in the meat section at the grocery store, and he would watch, housewives come in and watch their buying behaviors. And he would ask them, like, he'd say, hey, is the price of bacon too expensive, or is it a value, or is it cheap? And if they told him it was too expensive or that he didn't see them putting bacon in their cart, he would sell the lean hogs market. And if he saw them buying and they said that the bacon was at value or cheap, then he would buy the lean hogs. And he made a career out of this very simple concept. So I've become an observationist. I'm going to go to Costco. I was at Costco a few weeks ago. I was watching folks and seeing what they were putting in their shopping carts. And I was standing by the frozen food section. And every time somebody would come down the frozen food section, they were opening up the section where they had French fries or tater tots or some kind of frozen potato product. And I was kind of thinking that maybe inflation is starting to have an effect on folks' groceries, their budget, and that they were looking to substitute foods that were cheaper, potatoes. So I did a little work, a little homework. I went and looked at different potato manufacturing companies that are selling frozen potatoes. Now, there's some of those larger ones you probably think of like Ore-Ida and these conglomerates. But I found this stock, this one, LW. And I was looking at this chart, and I was thinking about how I trade, the things that I want to look for. And I really like this chart. First of all, this stock has been in a dominant downtrend for a long period of time, but at the bottom of this trend, we see a nice V bottom, change in direction, very hard change in direction. And not only did we get a V bottom, but that V bottom led to a trend line break, a break above our trend line. And that trend line break was confirmed as price broke out of an area of resistance, this 59.60 level, a breakout move. And this is how I like to look for trading opportunities. I saw a trend, I looked for the markets that relate to that trend, and I found a chart that fits my trading philosophy. And so I took this breakout trade at 59.60. And the market is now rewarding me. So I'm up about 8% on this trade in only about 2 weeks' time. Not a bad trade in the short period of time. Now, what has happened now is, unfortunately for me at this point, is I have an event coming up. And that event is earnings. And we can see here that this particular stock, over its last 3 earnings events, didn't perform well. Now, maybe things have changed, but I need to be cautious because of earnings. So what I did was on this trade is I raised up my stop to break even, but I also looked at options, and I went to sell some covered calls. I sold a $65 call that allowed me to bring in $2.25 worth of credit. That would limit my gains to the upside if the earnings was positive, around $67.50. But still a nice, almost a 15% return on this stock. But it also gave me that $2.50 credit based on my entry costs of about a 4% buffet. So that would allow me to take a little bit of a hit. Now, if this market did go back below that 59.60, I probably would be out of this trade. But I would still be able to keep a good portion of that $2.50 of credit that I received from that call trade. So when everybody's running around telling you that the stock is great or this is one is going to go up or whatever, probably everybody's already in that market. And so what William O'Neill is really telling us here is think independently. Find your own ideas. Find your own trends. Make your own decisions. Don't follow the crowd. Humphrey Neal has a book about contrarian trading or contrarian theory. And I have become more of a contrarian as I've gotten older in my years. But I love this statement. Public is often right during trends. Trends your friend until the bend of the end, right? And that's when the public is wrong, or they are wrong at the ends. But a lot of times these ends are also trading opportunities for those who are swift and are decisive and find their own trading ideas. And then this quote, which I love, is from Peter Lynch, one of the founders of Fidelity. Invest in what you know. Trade what you see. Trade what you know. Trade your own personal habits. Trade in the stocks that you believe in, that you use in your everyday. And this definitely is one of the mantras that I've used in my life, and it seems to have been pretty successful. Okay, so those are our 5 common traits among our successful traders. So what I want to do is give you guys a couple final thoughts. And not that I'm some great trader, but I have been around for a long period of time, and I've been around the block, and I know where all the good parking spots are, so to speak. Trading isn't about making money. I know that's a hard thing to conceptualize. Our bottom line of our P&L is just a measuring stick. Trading should be a means to an end. And our success should be measured by what we get from trading, be it financial security, be it material goods, be it spiritual, be it philanthropy, and not in dollars. Jones, when he became successful, went into philanthropy, and he opened charitable trusts, and he was scholarships for inner city kids. And I remember reading an article, an interview from him a few years back, where he said as he's gotten older in his ways, that because he has this charitable trust that he donates to and then his family runs, that his trading has, I wouldn't say more conservative, just more selective, because he's always thinking that he's risking these children's futures or his charitable trust future. So he tended to be a little more selective in his trading ideas, because he knew the ultimate goal was to get these scholarships out to folks. Jim Cramer, another TV personality, right? He always talks about his charitable trust. So it's important for us as traders, and what I've learned from a lot of these successful traders, is don't think about trading in terms of money. Set goals, set objectives, set ways that you will reinforce positive action, positive trading action in your personal life. Don't say, I want to make $1 million. Right? That's thinking about money. Instead, what you should be saying is, when I make $1 million, I'm going to buy a new house, buy a boat, start a charitable trust, open a soup kitchen, take care of my grandkids, pay for their college. A means to an end. Ed Seykota was a successful trader, and he's interviewed in a book called Market Wizards. And I love this quote because there's really 2 things in here. First of all, he says, win or lose, everybody gets out of the market what they want, right? And I really do believe that. I really do believe if you are disciplined, you are structured, you respect risk, that whatever goals you want to achieve, the market will allow you to do that. But there are some people who have no rules or have no plan. Their plan is to fail. And some of these people seem to like to lose. And so they get what they want. And by losing, they're winning. That's what they wanted. Because they didn't have rules, they didn't have plans, they didn't have structure, they didn't have discipline. And I've seen it many times. And those successful traders that have gone on and been successful and are tested the time, these are the ones that have other goals than just making money. And the final thought here is really kind of reinforcing what William O'Neill was saying. You don't have to trade every day, right? Be patient. Look for trading opportunities that have come to you. Did you know that for most markets that they only trend about 20% of the time? The rest of the time, they're just kind of stuck in a range. Well, if you think about that, on any given week, maybe you only trade one day a week. Maybe there's only one opportunity a week for you. Be patient. Wait for the opportunities. Enjoy life. The market is always open. It's always there. It never closes. There's always another opportunity somewhere down the line. All right, so I hope you guys enjoyed that today. And like I said, this was a little bit different from what we've done in the past, a little bit more about food of thought. Take some of these ideas that I presented to you today and see if you can incorporate them into your trade plan. Now, I do see a couple questions popping up here and see if I can answer those questions. And then what I want to do is I'm going to share with you some of these books and where I got some of these quotes from. So Theodore is asking something about food prices, commodity inflation is definitely here. What's the best way to screen for stocks in food commodity space? Well, I think you'd have to look for, first of all, what food commodities are going up. Well, inflation is everywhere. But, you look at cocoa. Cocoa has one of the few commodities that hasn't really appreciated over the last year. So that might be actually beneficial to those companies that use cocoa. For instance, Hershey's. They might be able to pass on price increases because of the consumers are anticipating. So I think instead of looking at what commodities are going up, I would look at what stocks and screen on things like cash flow or quarter-to-quarter earnings. I want to see a rise in quarter-to-quarter earnings. And Theodore, we're actually going to do this next week. So it's kind of cool that you asked that question. Our next week's session is going to be talking about trends and how we can use the screener to find some of those trends. So Franco asked me a question, do I know The Phantom of the Pits, a history by Art Simpson? No, I don't. I will put that on my reading list. Thank you for recommending that one. Okay, so speaking about books, so here is a list of about 15 books. I think it's 14 books here. And when I was putting this together, there's no hierarchy or importance of one book over another. But I will mention that the first 3 books that I chose were the first 3 that popped in my head. Market Wizards by Jack Schwager. These are interviews of great traders. And I think he has 2 books. I mean, he might even have a 3rd book now of these interviews. And in the first book, if you read the first book, a lot of the traders that he interviewed were also a lot of these traders that I had the opportunity to work with or get to meet to talk with. Remnants of a Stock Operator, The Life and Times of Jesse Livermore. This is definitely one of those books that my mentors have always recommended to me, and I've always recommended to other traders. A lot of life lessons in there. Very simple, very direct, and very timely. Trading in the Zone, that psychology of trading, the psychology aspect of trading. Now, if you asked these traders, these successful traders, and you ask them a very direct question, you say, What is the greatest risk you face as a trader? And they're all going to say the same thing, I guarantee it. Greatest risk traders have is the trader themselves, right? That human aspect, that mental capacity, right? Overcoming our fears, our greed, our emotions, becoming mechanical and disciplined. So this is a great book in terms of that psychology of trading. There's a few books there about technical analysis. Marty Zweig, another book that has been recommended to me many, many times. And you hear a lot of other professional traders will say that this is one of those books that is a must read, Winning on Wall Street. There's that book about contrary thinking. This is one has definitely influenced my trading style over the years. Fooled by Randomness. This book here, remember we talked about how your trading plan might be a working trading plan that has been profitable, but all of a sudden something has changed. The market has changed or something, and then it doesn't work. So in this book, Taleb talks about that a lot of traders don't realize that their plan might be just the right plan at the right time for the right market. And that when markets change, their ignorance or their arrogance is that they continue to deploy their plan and they get crushed. That adaptability, you got to learn how to adapt to the changing markets. I'm certainly, my style of trading has changed over the 3 decades that I've traded, and markets have changed dramatically over that period of time. So that's a great read in terms of understanding about survivorship or this adaptability. How to Make Money in Stocks, another William O'Neill, again, another book that I constantly get told by other traders, other mentors of mine, a lot of great information in there. Peter Lynch, that One Up on Wall Street, Trade What You Know, Against the Odds, a remarkable story of risk. Peter Bernstein talks about how risk has developed from parlor games in Renaissance France to these complex derivatives that are driving our markets today. And then finally, this last book, it's a little different. Malky talks about indexed investing. So read this book and see what you think if he's right or wrong. And send me a message. Tell me if you think that you believe in what he's saying. It's a very interesting read. All right, so I do have time for 1 or 2 more questions. So Zach asks a great question. How do you avoid falling in love with a stock, and when do you sell your winners? So first of all, love is an emotion, Zach. So the easiest way for us not to fall in love with stock is not to think about it in terms of money. It's, again, just letting the market tell me when to get out, right? When the trend has changed, when the market reaches one of my targets, right? I want to let that trade run as far as possible, right? Maybe every time I reach one of my targets, what do? I raise my stop up and raise my stop into a position of profitability. And if that trend changes and the market falls back and stops me out, well, it stops me out for a profit, right? I don't get married to a stock. I don't care, right? It doesn't love me back. I just want the market to continue to move in my favor. And once it doesn't move in my favor, then we're out. Let's see. Daniel asks, does any book come to mind considering the variety of types of market orders? I think I'll have to think about that one, Dan. And Dan Abraham asks, do I believe in market timing? I believe in market timing in terms of waiting for greater opportunities, but I really do believe that the true value in trading, or the real way we are successful as trader, is all about risk control, right? All the different technical analysis, all the different things that are out there, they can enhance our trading. They can maybe help us find greater opportunities. But I do believe that every trade is a winner and every trade is a loser. It just depends on your risk management. Okay. So I see a lot of other questions about, particularly about inflation and stuff like that. And again, we're going to do some great subjects coming up in the next few weeks, and I think a lot of those will be answered for you folks. Okay, so let's just move on before we run out of time. I'm not a member yet. Great opportunity to become a member of Barchart. We do offer a free basic membership that does allow you access to some of our starter tools and features, but there is definitely a benefit of being a premier member. We do offer a 30-day trial period that allows you to test out some of these premier features, and a lot of our webinars moving forward are going to be more in line with some of these premier features that we're going to talk about coming up. And if you look over there on the right, you can see that it's about $16 a month. That's $200. So my hope is that today's session, my 40 years of experience that I've just brought to you, that it was worth $200 worth of knowledge, and that you're already ahead of the game. Very small price. I think that you'll find that the benefits of being a Barchart premium member that small risk will return a large reward. Okay, Jean, did I forget anything, or is there anything that you're seeing out there?
Yes. One thing, I've got a common question throughout. Everybody wants to know if they can get a copy of these slides. And on our webinar archive page, where the video is going to be shown a little bit later on this afternoon, you can download the slides right now. So, John, if you click on the 5 common traits, watch now. Yeah, the video is not out there yet. Give us a couple hours to do it, but right over in the top it says download slides in PDF format. So you can get John's slides right now if you go to that page.
Yeah, you can get that book list, right? Start your own trader's book library. Okay, the other thing that I know Jean is going to want me to talk about is our upcoming sessions. And our next section we're going to do next week is 2022, new year, new trends. And what we're going to do is we're going to look at the trends that played out last year, see which ones might follow through for this year. We'll identify some of the trends that seem to be playing out, and we'll talk about business cycles, sector rotations, and we'll go into Barchart feature tools, stock screeners, and we'll look at how we can start looking for some trading opportunities. What I've been doing too is in getting prepared for this one is I've prepared a watch list or a hypothetical portfolio like we did last year at this time of some stocks that I think could take advantage of some of the trends that will be that could come out play during this coming year. Anything else, Jean? Did I get it all?
I believe so, yeah.
Okay, great. So listen, everybody, thanks so much for joining us. I want to wish everybody a happy and prosperous new year. Stay safe out there, be healthy, and the good of all trading.